From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, your Financial Quarterback since 1993. The Secure Act passed late last year and takes effect this year. So here to help us understand what this means for your taxes and your required minimum distributions is Director of LFG Tax, Mark Sipos. So Mark, really this changes the way that people could handle their required minimum distributions.
It really does. If the original account owner had started their RMDs, there is one required in the year of death. So if it happened before the decedent passed, they would claim that on their final tax return. If that RMD happened after date of death, then the beneficiaries need to include that on theirs. And then moving forward, the beneficiaries use their life expectancy to calculate their RMDs.
So that's pretty confusing, but what happens if there was no RMD or it didn't start yet?
If it hasn't started yet, then there are no RMDs, but the rules are different for spouse and non-spouse beneficiaries. Non-spouse beneficiaries don't have RMDs, but they have to drain that account within 10 years.
But it sounds like a spouse could be treated as the IRA original owner.
That's correct, but there are also special rules. For example, if that spouse was more than 10 years younger than the decedent, special restrictions apply.
Yeah, and there are other considerations as well, including different rules where minor children are involved or maybe a disabled beneficiary. There could also be chronically ill individuals that may inherit things, and also even new rules for non-spouse beneficiaries.
And in previous years, if you didn't take that RMD in a timely manner, the IRS could penalize you up to 50% of that distribution. The Secure 2.0 Act now reduces that to 25% and can even be 10% if you rectify that situation in a timely manner.
Yeah, in addition to the changes to the Secure Act 2.0 that was made this year, we're also seeing some changes from 2021 that became more useful in terms of the SGO credit.
Yes, that's a scholarship granting organization, and Ohio has instituted a new tax credit specific for those that are donating to those. So in Ohio, if you donate up to $750 to a qualified SGO, you get a dollar-for-dollar tax credit against your tax liability. Married filing joint couples can do up to $1,500, but you must each individually give $750 to make that work.
Yeah, and I know you're also encouraging clients to multiply the effectiveness of this strategy by also using a QCD or qualified charitable distribution to make that contribution.
Yeah, QCD is a great planning tool for RMDs that can be used for charitable donations. So your distribution is not taxed at the federal or Ohio state tax level. So if you fund the SGO using a QCD, you get to double down. So you're not paying tax on the distribution and you get that tax credit.
Mark, thanks for all that great information. As Mark always reminds us, even though we're not in tax season, many of these strategies have to be implemented before the end of the year. So call Mark today and we're both here to help. Stay tuned for Fox News Sunday.